The MAS's decision last week to move off cycle and tighten policy settings, we're seeing the Singapore dollar continue to benefit from that in part so far in today's session. But as we know, a stronger currency doesn't always support exports and could make exports from Singapore a bit more pricey. Do you think that there is a reason to be concerned, at least, that a stronger Singapore dollar to head off inflation here might actually blunt some of this export momentum that is surprisingly stronger than what many were expecting? What are your thoughts on that, sir?
Well, I think that's essentially how the framework is designed, right? The Singapore dollar framework is exactly meant to slow down exports as the Singapore dollar appreciates relative to the policy band, and that will naturally slow down the rest of the economy as the drag broadens out beyond the manufacturing sector into the services side of the picture. I mean, make no mistake about it, the economy is definitely operating above its potential. We have a lot of labor shortages across the economy, across many sectors and across many jobs. It does look like the economy is, as I said, slightly outpacing what it should be producing right now. And so, although you're right in that the stronger Singapore dollar is going to weigh on export momentum, that might be precisely what we need to try and start to cool down some of the very strong demand side inflation pressures that we're seeing in the economy arising from that very strong demand across the board, including from exports and manufacturing.
Well, the Singapore government has been early in trying to head off any potential threat from inflation. Where do you see that going? Where do you see Singapore's inflation picture and interest rate picture topping out? And what do you see as being the knock-on effects for retail lending rates and the domestic property market?
Well, I would say that as we get into the second half of this year, clearly the inflation picture is key to watch. I think that given the labor shortages that we have in the economy, it's very likely that these pressures will persist. Yes, the government has opened up the borders to try to alleviate some of these labor shortages by making it easier for people to tap on the supply of foreign labor abroad. But it very likely will take time, and the recovery could be quite gradual, and therefore it's very likely we will see inflation being still quite sustained as we get into the second half of this year, and maybe only starting to cool off towards the end of the year. Now, as for the property market, the Fed is clearly hiking, and that is a situation that should weigh on what's going on in the residential property market. But at least in the near term, it does look like there is quite a bit of a fundamental shortage in supply that needs to be cleared out. Some of it is being cleared out, but it will very likely, again, take time because, constructing all of these new HDB flats and supply of private property is going to take a few years, and it's not going to be a quick fix to bring property prices down.